desire to invest in the real estate market, purchase several properties, and even own your own home, but you have been unable to do this because of the unfavorable house market prices? Or have you found the purchase of properties significantly unaffordable and now you believe this to be an insurmountable challenge? Well, I have the ideal solution that will address all of these challenges. In this video, I'll be sharing a secret that will help you access this real estate gold mine without breaking the bank. Now, this solution will not just give you access to this market, but also give you an opportunity to make the best of gains with little investments. So if you're interested in this, ensure you continue watching till the end so you don't miss this gold mine. Hey everyone, my name is Ebuka and this is the Finance Wiz channel. I'm a finance expert with over a decade of experience in the finance space. This channel is dedicated to simplifying personal finance topics around areas such as income generation, investment, savings, debt management, and providing you overall tips to help you on your journey to financial freedom. Please like, subscribe to the channel, and share with your friends so they can also get the value you are getting from my videos. Also, I'd like to encourage you to hit the notification bell so that you'll be notified when a new video drops subsequently. So we can actually agree that investing in real estate can become a highly profitable venture if done right. In fact, real estate has become one of the most popular and sought after forms of investment in recent times. However, not everyone understands how the market works, especially considering how unfriendly the market has become today. Now, as someone with several years of experience in the finance space, I've noted from my interaction with several clients, individuals, friends, and so on, that most people believe there is just one major way to access the housing market. Now, of course, you know the traditional way, which is to save the down payment over time, get a mortgage, and purchase a home with your mortgage, or even pay outright cash. However, my major challenge with this traditional approach is that it requires breaking the bank or parting with a lot of cash, of which many people don't truly have today. Well, one of the easiest alternatives that addresses this significant challenge is the investment in real estate investment trust, otherwise known as REITs. Now, for the purpose of those that don't know what REITs are real estate companies that own income generating real estate assets such as apartments, warehouses, self-storages, malls, hotels, and many more. Now, if you choose to invest in a real estate investment trust, these real estate companies will typically pool your resources along with similar investors like you and use it for all their real estate projects, purchases, and many more. So if you're confused as to why you should invest in real estate investment trusts, I'm going to be giving you 5 reasons why I think this might be a worthwhile investment for you today. The first reason is that it offers you a hands-off real estate investment opportunity where you don't have to be directly involved in the complexities of purchasing a home and managing the property as the time goes on. The second reason is that it serves as a means to increase or diversify your portfolio. Now, onto the next reason, REIT stocks typically offer a passive income opportunity, which most times operates differently from the operations of the stock market. Now, the fourth reason is what I call the upfront cost and investments. Now, I love REITs because it offers you an opportunity to invest in real estate without actually purchasing the property physically. Now, the last reason why I think REITs might be a worthwhile investment for you today is the liquidity factor. Now, if you choose to liquidate your investment in real estate at this point, REITs might actually be an easier option for you to liquidate your funds when compared to physical properties. I've selected a list of my top 5 best REIT stocks, which I think might be worth considering today based on my analysis. So my first REIT is called Prologis Incorporation, trading with the ticker symbol PLD in the New York Stock Exchange. Now, Prologis is a REIT headquarters in San Francisco, California. The business majorly invests in logistics facilities, and the company was formed through the merger of AMB Property Corporation and Prologis in June 2011. This merger made Prologis the largest industrial real estate company in the world. As of December 2022, Prologis owned 5,495 buildings in 19 countries across the whole of North America, Latin America, Europe, and even Asia. This business currently serves over 6,600 tenants. Now, why I believe that PLD might be a sustainable business into the long term is that it has expanded its business even to non-real estate related areas, such as solar power, racking systems, forklifts, generators, and even EV charging infrastructure. EV stands for electric vehicles. Now let's take a quick look at what Google Finance says about PLD's stock performance. Now if you can see my screen, you see that PLD currently trades at $121.47 on the New York Stock Exchange, right? Now let's take a look at the 5-year performance of PLD. Now when you look at it, as at 2018, PLD's price was sitting at $66.09 and it has grown up to $121.47 at its current price today, which is about 84% growth in 5 years. I think that's a pretty good performance. Also, you can see its all-time high sits somewhere around 162.7, which means that this business or this stock has the potential to grow even further. This stock has a market capitalization of 112.2 billion USD. And now if you scroll down all the way to its financials, we can take a further look at its financials. Now when you look at the annual income statement, you can see that the revenue has grown from $3.1 billion to about $6.28 billion in 5 years, which is almost double or more than double of what it was in 2018. Also, its net income has grown from $1.65 billion in 2018 to about $3.36 billion. This gives me a sign of continuous growth of the business. Now let's take a look at its balance sheet. Now, if you look at the balance sheet, as of 2018, it has a total asset base of $38.42 billion, and this has grown to $87.9 billion. Amazing, right? Now, when you look at its liability, $12.62 billion, it has grown up to $30 billion, which means that there is no direct proportionate growth between both. Another exciting thing about PLD is that it pays a dividend yield of 2.86%, which means that for every $1,000 you invest in this stock, you should be getting about $28.6 in your dividend on an annual basis. My second REIT stock is what I call VC Properties Incorporation. Now, this stock trades with the ticker symbol VICI on the New York Stock Exchange. Now, VC is a REIT that specializes in casino properties that are majorly based in New York City. It was formed in 2017 as a result of a bankruptcy reorganization of another company. This business currently owns 48 casinos, several hotels, racetracks, and 4 golf courses around the United States and Canada. Now let's take a look at what Google Finance tells us about the performance of this stock overall. So as you can see from my screen, VC Properties Inc. trades at $30.08 in the New York Stock Exchange. Now if you look at the 5-year performance of this stock, you can see that it has grown from $20.07 all the way to its current price of $30.08, which is a 45.31% increase in the stock price. Okay, now the other good thing about it is that it has a strong market capitalization of 30.48 billion USD, which you can see my mouse hovering over, and it has an all-time high of about $33.64. So let's take a look at the financials of this business as well. Now when we click on the annual financials, we can see that this business has experienced significant growth from 2018 to 2022. Now as of 2018, its revenue was sitting at $897.98 million and net income at $523.62 million. Of course, the revenue has grown from $897 million to $2.66 billion. Amazing. Now, its net income has also grown from $523 million to about $1.12 billion. So if you look at the balance sheet as well, you can see that significant growth also reflected in its asset base. Now, the total asset has grown from $11.33 billion to about $37.58 billion. Also, its total liability has grown from $4.43 billion to about $15.29 billion. Now, if I just look at it at the very surface level, it's safe to still say that the total asset comfortably covers the total liabilities. The other good thing about this stock is that it has a returns on capital of 3.86% and of course a returns on asset of 3.78%. Amazing. The other thing is that dividend yield in this stock is 5.19%, which means that for every $1,000 you invest in this stock, you should be getting about 51.9 USD on an annual basis. So my third REIT is what I call the Simon Property Group. So Simon Property Group Incorporation trades on the New York Stock Exchange with the ticker symbol SPG. Now, SPG is an American REIT that invests in shopping malls, outlet centers, and community of lifestyle centers. This business is the largest owner of shopping malls in the whole of United States, and it also has headquarters in Indianapolis. As at the end of 2021, it had a worldwide property ownership of 232 units. Now let's take a brief look at what Google Finance says typically about the performance of this stock. Now you can clearly see that this stock trades at 115.60 USD. So if you take a look at the 5-year performance of this stock, you can see that it has dropped from 183 to its current price in 115. Now, the face of it, this might scare you, but let's take a little deep dive into its current performance in the last 1 year. Now, when you take a look at its performance in the last 1 year, you can see that it's simply recovering from the downturn in the markets, maybe in the last 1 to 2 years. Now, other things to also consider is a market capitalization of 37.82 billion USD. Now, let's take a deep dive into the balance sheet as well. Now, when you look at this balance sheet, you can see that the total asset has dropped from 30.69 billion to about 33.01 billion. Overall, I think there has not been so much variability in the returns of this business as well as the asset base of this business. Now, in terms of dividend yield of this business, it sits comfortably at a 6.57%, which means for every $1,000 you invest in this stock, you should be getting about $65.7 on an annual basis. Now, my fourth stock is called the Tanja Factory Outlet Centers. This stock trades on the New York Stock Exchange with the ticker symbol SKT. Now, SKT is a REIT with its headquarters in North Carolina. It majorly invests in shopping centers that contain outlet stores in the whole of Canada and the United States. As of May 2023, the company owned 37 shopping centers, which comprised of 14 million square feet and more than 2,700 stores. Now let's take a high-level look at Google Finance performance assessment. So you can clearly see that this stock trades at $23.57. Now when you look at the 5-year growth, you can see that it has dropped from its previous price of $24.23 in 2018 to its current price. However, do not be dismayed, because if you look at the current 1 year's performance, you can see a growth of 38.73%, which implies some sort of recovery. Even when you take a look at the year-to-date performance, you can also see a 33.09%, which also implies even better recovery. Now, this business has a market capitalization of 2.48 billion USD, and if we scroll down to the financials of this business, you can see that the change in revenue and net income has moved from 502.79 and 43.66 million to about 451.21 million, and of course grown to 82.06 million for its net income, which means that although its revenue dropped slightly, it has found ways over these last 5 years to reduce its operating expenses. Now, if you take a look at the year-over-year performance, you can see that the revenue has grown by 3.62%, and its net income has also grown by 800%. This is also another indicator that the business is performing well so far. Now let's take a look at the balance sheet of this business. Now the balance sheet, as you can see, has shown its total asset has gone from 2.38 billion to about 2.22 billion, all right? And its total liability has moved down from 1.88 billion to about 1.7 billion. However, if you take a look at its year-on-year growth or performance, you can see that the total asset has grown by 2.79%, and of course the liability has grown by 2.78%, which is a pretty fair balance. Also, the other thing is that the dividend yield of this stock sits comfortably at 4.16%, which means that for every $1,000, you should be getting about $42 as your dividends on an annual basis. So the last REIT stock I'll be talking about is Iron Mountain Inc. Now, Iron Mountain Inc. trades with the ticker symbol IRM on the New York Stock Exchange. IRM is an American records management service provider which was founded in 1951 in Boston, Massachusetts. Now, this business is classified as a REIT simply because it was organized in that form. However, its core business is physical record storage and management, which is actually where most of its revenue comes from. Now, the challenge with this business is that the world is going more digital by the day, thereby reducing the demand for paper storage, which could affect Iron Mountain's business. However, Iron Mountain did not sit and watch things unfold. In order for Iron Mountain to match with this competition and this increased or dynamic demands, Iron Mountain has started to build data centers. And today, as we speak, around 95% of Fortune 1000 companies uses its data center services today. However, I want to give a note of warning if you're considering investing in these REITs. IRM has a fast-growing debt leverage, which I'll be showing in the balance sheet on my screen soon. That's because for it to continuously build its data centers, which is actually capital intensive, it would have to look for sources of funding those initiatives, which could likely be from its profit or revenue of the business. In other words, it will have to reinvest some of the profit it makes in the production and design of data centers across the world. However, this might be a bit challenging for the business because REITs are popularly known for high-paying dividends. In other words, REITs tend to pay a large part of their profit as dividend and retain very little for its continuous growth. Therefore, this might cause a big impediment to this business to grow through reinvestment of its profit back into the business. As such, I strongly believe that this organization might resort to loans and other debts or maybe other forms of finance to fund this initiative it has. So if you decide to invest in this stock, I would recommend that you closely monitor the balance sheet of the stock over time to ensure you are making good profit and making better decisions over time. In other words, continue to reassess the business performance and operations over time. Now let me show you what Google Finance says about this stock and its performance in the last 5 years and its current year. Now, Iron Mountain, as you can see from my screen, trades at $59.11, and you can also see that this stock price has grown from $35.36 in the last 5 years to its current price of $59.11, which reflects a 65% growth of this stock price. Now, if you also take a look at this 1 year, it shows continuous growth as well of 7.71% and a 19% increase in its year-to-date performance in terms of its share price. Now, this business has a market capitalization of 17.25 billion USD, and if you scroll down to the balance sheet, which is very important that you need to watch out for, in its income statement, you can see that its revenue has grown from $4.23 billion to $5.1 billion. And its net income has grown from $353 million to about $556 million. If you also take a look at its year-over-year changes, you can see that revenue has experienced a 13.63% growth and its net income has experienced a 23.7% growth. Now, diving into the balance sheet, which is the most area of concern, you can see that its total asset has grown from 11.86 billion to about 16.14 billion, which could simply be about the data centers it continues to produce or create, right? Now, if you look at its indebtedness, it has grown from 9.92 billion to a whopping 15.41 billion, which is not even a proportionate increase in the relationship between the total assets and the total liabilities. So you need to be wary of the growth in its debts and monitor it closely to see if it still aligns with your overall goals as you go on. Now, if you look at the year-on-year performance, you can see the total asset has grown by 11.7%, and of course the total liability has grown by 13.96% as well. Finally, dividend yield of this stock is sitting at 4.4%, which means that for every $1,000, you should get about $44 on an annual basis. Okay, those are my top 5 REIT stock which I've considered to be worthwhile investments. Overall, like I always say in all my stock videos, remember this is more of informational purposes and you need to do your due diligence as possible and of course consult a financial advisor where necessary. Finally, if you found this video very useful and insightful, and you are interested in similar videos subsequently, feel free to subscribe, share with your friends, and drop a comment. Also, I'm interested in knowing what type of stocks or category of stocks, including personal finance topics, you'll be interested in me talking about in my subsequent videos. So if you have any other areas in mind or areas of unclarity, feel free to drop those areas in the comments and I'm going to do a video to explain those concepts or simplify them for your use. Alright, thanks for taking the time to watch this video. I would say have a great day and see you at the next video. Bye.